Greetings from Finstudyclub. My name is Ankur, welcoming all viewers to a very creative and important series of videos where we will be covering some of the 10 important questions on each subject. So this is like an initiative from Finstudyclub wherein each subject, according to the weightage and the number of concepts that it has, some of the very selected questions will be taken up, specifically keeping the exam practice in mind. Now here, there's like a quick disclaimer that we do not guarantee that the questions are going to be from the concepts that we are taking here, but with the experience that we've had so far, these are some of the very critical concepts that a student should definitely know before landing up in the exam. So we are going to start with corporate finance, followed by some of the other modules over a period of 1 week. So we have here corporate finance, starting with this first question. So the way to look at this type of creative video series is you have this question like here on your screen. So I would really love if you can take a shot at this on your own. So the way to do that is you just pause the screen right now and try and spend 2-3 minutes to look at to do this question yourself. Once done, then just look at my answer to it and then try and see if both of them matches. If yes, well and good. If no, then try and find out the reason for it. Okay, so if let's say we're starting from question number 1 here, so just pause the video right now, try and look at this question yourself, and once done, then maybe continue to look at the video. So here I am giving you the answer for this. Now let's just read on this. Like, Coal India is planning a new coal mine which will cost $100,000 to build, with the expenditure occurring next year. The mine will bring cash inflows of $50,000 annually over the subsequent 7 years. Okay, it will then cost $17,000 to close down the mine over the following year. So I'm noting down the time frame, and the amount of expenditure very carefully. Assume all cash flow occur at the end of the year. Alternatively, the company may choose to sell the site today at T0. The question is, what minimum price should the company set on the property given a 16% required rate of return? Now this question basically talks about that at T0 you have two choices. One, to sell today for a particular price, which is what we need to find out, and the other one is to operate the mine and get profit. Okay, or in corporate finance terms, get the net present value. Here I'm going to choose the option which is going to give me a positive value, but here, since the selling price is not there, the minimum selling price is going to be the gain that I'm going to make from the other option. So this really becomes the opportunity cost right here. Okay, so so I'll be doing is I'm going to find out the NPV if the option of operating the site or opening up and then shutting it down after 9 years is there, and I'm going to calculate the NPV and discount that at 16% to make that as a minimum selling price, because at that level that's the break even is going to happen. So here is my question, which is bottled down to a particular time series. Let me just draw that line and plot some of the cash flows right here. So you have T0 where the decision is to be taken. You have to look at the timeline very carefully. Now the expenditure to build the mine is not happening today, it's happening at T1. Okay, now the inflows of $50,000 is happening for 7 years, including T2. So T2, 3, 4, 5, 6, 7 and 8. So 1, 2, 3, 4, 5, 6, 7. So up to T8, 7 times I'm going to get 50,000. And after that at T9, it is again going to cost me You can't leave the mine open like that. You got to close it properly. So these are like the cash flows for me, and I'm going to calculate the net present value discounting them at 16%. Okay, so just on the beta 2 calculator, I'm going to use my cash flow function. So I'm going to put CF0 as 0, then I'm going to put CF1 as negative 1 lakh. I'm going to put CF2 as 50,000 positive with frequency. If I press enter, I'm going to get F2 with frequency of 7 times. So automatically this entire screen will be captured. And then when I press enter, downward key, I'm going to press CF3 as again negative 17,000. So on pressing NPV button, it will ask me I by Y, which is going to be 16%. And again pressing that enter button, I'm going to get the NPV compute equal to 83,398, okay, as a positive number. So this number basically denotes the profit that I will be getting if I operate the mine for whatever number of years. So the question is, what is the price that I should be selling it for? Obviously there is no cost involved in selling, so the answer to that is the minimum price is $83,398. Just a small modulation of this question. If let's say if I sell the property today and let's say there are selling costs of $2,000, this was like the additional thing which was given, then in that case let the selling price be X minus 2,000 should be equal to the profit that I've been able to generate. So in that case, if the cost would also be there, then my selling price should have been 85,398, because then the comparison is on the net take home. Here, while you're selling it, there is no cost involved, so therefore whatever you sell it for becomes your net take home. However, in the case of the operational aspect, 83,398 becomes the net take home. So I hope that this particular important question from capital budgeting is clear. I'm moving to my next question, and again the way we are going to do it, you just pause the screen, read the question at your own pace, try and spend not more than 2 minutes on this, and once done, just continue with the video and look at it if your answer matches. So here I am with the answer. It says two projects have the following NPVs: 4,500 negative and 5,500 negative. If the projects are mutually exclusive, which one of the following projects will be chosen? Well, 90% of the students would have answered A, because A has greater NPV. NPV of A is greater than NPV of B, and in fact this is one of the rules of selection of the mutually exclusive project, that you got to select the project with higher NPV. But you have to be mindful of the fact that mutually exclusive selection is a step which needs to be done after selecting an independent project. So the point I'm driving home is that from the total options, you got to select the good ones where the benefit is more than the cost, and from all the good projects you need to select the best one. This entire exercise is the exercise that you do for independent projects, and this additional step is done for mutually exclusive. What I'm trying to tell you here is that out of the total options that you have here, A and B, no project is good because both of the projects are having negative NPV. So if the project would have been independent, I would have not selected either of the two. And since now both of them are not so the good ones, there is no question of selecting the best out of those. So the answer to that is I am not going to select any project. So to remember, always remember the point that whenever you have to select a mutually exclusive project, you should understand that independently the project should be at least good, and the project is said to be good when benefits are more than the cost, when IRR is more than the WACC, when NPV is greater than 0, when profitability index is greater than 1. So these are like some of the parameters to check whether the benefit is exceeding the cost or not. Only then you apply this incremental approach. This is very, very critical to understand. The second point here is, what will be the answer if the projects are independent? Well, the answer is what we have discussed, that I'm not going to select any project, whatsoever. So I hope that this question also is clear, and I'm moving to the third question, which is again a very, very important question, which says that two projects being considered by the firm are mutually exclusive and have the following projected cash flows. Year 0, 1, 2, 3, project 1, and these are like the cash flows, -4 is like the outflow, and 3, 5, 2 are the inflows. Project 2, again, we don't know the value of the outflow which is there for project 2, but we know the value for inflow. So most likely the question is going to be, find the value of X. So here it is. What is the initial cash flow for project 2? The crossover rate of the two projects is 9%. Now the question is, you should be very, very clear and quickly be able to recall what is the crossover rate. The crossover rate, this question is from the concept NPV profile. The crossover rate was a rate wherein if you calculate the NPV of the two projects, the two NPVs would be same. So therefore, if I calculate NPV of A, that is going to come out to be equal to NPV of B if you discount the cash flows at 9%. So what you need to do is X. So the way I'm going to do is, I'm going to calculate the NPV of project 1 first, equate it to NPV of project B, and in any case I would have the PVCI. So what I'm going to do is, step number 1, calculate NPV of A. Step number 2, NPV of A will become NPV of B because 9% is my crossover rate. That's the basic definition of crossover rate. And third is, NPV of B is equal to PVCI minus PVCO. Okay, so I'm going to follow these three steps. So let me calculate the NPV of project A, which is equal to present value of these inflows minus 4. So the way I will do that is using my cash flow function, and I always press cash flow button and then clear work. So 4 negative becomes my CF0, my CF1 is 3, CF2 is 5, and C0 is 2. NPV, the I by Y is 9. I am getting an answer equal to 4.505. Now 4.505 also becomes the NPV of project 2 at 9%. So what I get is 4.505 is equal to, now I'm going to calculate the present value of this. Okay, it is 1.7. So again I'm following the cash flow function. It is C1 1.7, enter, 3.2, enter, and 5.8, enter. NPV at 9% is, so the PVCI is coming out to be 8.73. So if you deduct the value of 4.505, your PVCO is turning out to be $4.23. So that's how I'll be able to calculate the value of $4.23 as an outflow. So pretty interesting a concept. NPV profile, very important from an exam standpoint. Let's look at the question number 4 on dividends. It says that the company declares its dividend on 1st June, and this is just like a declaration date. You remember there used to be 4 dates. One was the declaration date, in the end was the payment date, and in between was the holder of the record dates and a couple of days or 3 days or 1 day, depending on the transaction cycle, the ex dividend date also used to happen. So this concept practically is the concept of different dates of dividend. So it says that the ex dividend, the date is 10th June and holder of the record date is 12th June. What it means is that if you sell your stock before 9th of June, you are going to sell it come dividend. You're going to get the reimbursement for the dividend from the buyer itself. But if you sell the stock between 10th and 12th, then you are in any case going to get the dividend from the company directly. So what will happen is, let me just plot that thing here, 9, 10, 11, 12, 13, etc. So my record of the holder date is right here and my ex dividend date is right here. So what an investor does is, an investor holds 20 stock in a company and he sells 12 shares out of those 20 on 9th June. Now if I sell these on 9th June, then my share will be sold at a come dividend price. That means the company will not pay me dividend because the name of the new buyer will be entered before 12th, and in that case I'm going to get a reimbursement only from the the new investor. That means out of 20, 12 shares are gone and I'm going to get dividend only on 8 shares. The company has declared a dividend of $2 and therefore I'm going to get $16 as dividend from the company. There is no doubt in my mind that while selling these 12 shares, my come dividend price would include the $2, and therefore these $24 that I'm going to get from the new buyer as a reimbursement and included in the price of the share itself. So overall he's going to still get $40 as 2 into 20 stocks. But the question is, how much is the dividend received by the investor? And the question here specifies by the company. I mean, that's the broad understanding by default. Okay, so the answer will be 16. I'm going to tweak that question a bit. And if, let's say, the shares would have been sold on 10th, in that case, now if the dealing will happen on 10th, the share price has already become ex dividend. That means the new buyer is not going to reimburse the seller or my this investor for any dividend. And the reason for that is that maybe the registration will happen only by 13th. So on 12th, the name of my investor would still appear in the record of the holder date. Now if that happens, then the first thing that it tells me that my transaction cycle is T plus 3, because it's taking 3 days. There is a gap of 2 days here, and therefore my transaction cycle is T plus 3 days. So in which case I can conclude that if the transaction would have happened on 10th of June, my share would have become ex dividend and therefore no reimbursement would have come from the buyer. Entire reimbursement would have then come from the company itself, in which case the answer would have been $40. Okay, so moving to the next question. Well, next question is from the concept of leverages on the concept of the break-even point. Company ABC is planning to launch a new personal communicator. The device is considered to be highly innovative and is eagerly anticipated by the customer. Honestly, this is like the information not from an exam standpoint, nothing great to be done in the question for it. The total fixed cost in development has been $24 million with per unit contribution margin, which is selling price minus variable cost per unit, coming out to be $12,000. The company had borrowed from the market to fund its development. The interest costs are around 5 million. So this is the financial fixed cost and this is the operating fixed cost. The operating break-even and the break-even point are closest to, so it is like a pretty simple question. My operating break-even is equal to operating fixed cost upon contribution per unit, and my total break-even is equal to total fixed cost upon contribution per unit. So here I'm going to get 24 million divided by 12,000, and here I'm going to get 24 plus 5, that means 29 million divided by 12,000. So the answers to that will be 2,000 and 2417 units respectively. The question is, why do you have to sell 416 unit additionally? The answer to that is because now you have to recover an original fixed cost of $5 million over and above the the $24 million that you have. So another question which is pretty famous, and here is, can the operating break even ever be more than the total break even? The answer clearly is no. At max it could be equal to the two. Generally operating break even is going to be lower compared to the total break even because operating fixed costs tend to be lower than the total fixed cost. Reason being, there is generally some kind of a financial fixed cost on the capital structure. But if let's say the debt are zero, interest is zero, financial fixed cost becomes zero, so the only fixed cost on the capital structure is the one, the only fixed cost on the income statement is the one because of the business model, which is right here, the operating part, in which case the total break even becomes equal to the operating break even. Okay, so we are halfway down and I'm going to wrap this up in the next 10 minutes. Now pretty simple questions, but yeah, pretty fundamental from that standpoint. So I'm at question number 6. So I hope you are following the study pattern to pause the video, look at this question yourself, and then continue to find out whether you have been able to get it rightly or not. So my next question, pretty interesting, comes from the concept of the pure play method. It says the Coppel Incorporation is considering whether to expand its recreational sports division. So that's your new sector that you want to expand to. Coppel's capital structure is 75 to 25, which is roughly 3:1, and its marginal tax rate is 30%. So these are, Coppel is my subject matter company, and this is like the details of Coppel. Aspire brand is a publicly traded firm that specializes in recreational sports product only. So this appears to be like proxy for me. Aspire has a debt to equity ratio of 1.7, a beta equity of 0.8, and the marginal tax rate of 35%. Using the pure play method with Aspire as a comparable firm, the project beta that Coppel should use to calculate the cost of equity should be equal to what number? So if you will recall, there used to be 3 steps here. 1, you got to select the proxy, which the question has already done for me, and I'm going to use Aspire brand as the proxy. The next step is to calculate the unlevered beta from the beta equity of the proxy, and here the formula that I was using is equity upon equity plus debt 1 minus d. So here the important aspect was that I am unlevering this equity beta, and I'm going to use the figures of proxy. So putting in the figures, my beta equity of the proxy is 0.8, debt to equity is 1.7, so it is 1.7, and 1 minus d is 0.65. So that gives us the value of beta unlevered to be equal to 0.38. Now that's the operational beta of this particular industry, which is recreational sports division. And now using that, I will re-lever the same beta using the similar formula, but now I'm going to put that in a different spirit, wherein I'm going to calculate the beta equity equal to beta unlevered. Now the numerator is going to become denominator and vice versa. And now putting in the figures for the subject matter company, here beta unlevered is 0.38. It is 1. Now the beta equity is 3:1. So 1 plus 3, 70%, 1 minus t becomes 0.7 upon 1. So if you solve this, it is coming out to be 1.178. So to answer the question, the project beta that should be used by Copal for the new industry should be 1.178. Moving on to my 7th question here, which talks about the investment opportunity schedule. Now this schedule, if you would recall, was part of your weighted average cost of capital and the marginal cost of capital, and was one of the application concepts therein. So it was pretty much that the IRR of every subsequent project was falling and the marginal cost of capital was rising. So what is the amount of optimum capital outflow is the point where IRR becomes equal to marginal cost of capital, which is basically the concept of MR equal to MC. Okay, now the question here is that the investment opportunity schedule, this particular graph, is a good tool to assess what? For option A, whether to accept the project, a yes and a no. How much total capital to be raised? Certainly yes. The total gain made by the firm as per the investment done? Certainly no. Now I have a little confused between A and B, because at the end of the day, this also tells me graphically whether or not to accept the project. So in a way, A could also be the answer. But if you look at option B, this is absolutely bullseye. I mean, that is the main objective of creating an opportunity schedule like this, just to get to the amount of capital which is the most optimum capital budget to be raised by the firm. The evaluation whether or not to accept the project is typically done by the techniques, the ARR, payback period, NPV, profitability index, and IRR. So investment opportunity schedule is really not meant primarily for that. So while I agree that this could have also been one of the options, which is correct, but option B appears to be a better option to mark. Therefore I'm going to mark option B here. Okay, so in the exam sometimes you got to follow some of the options in a relative sense. So coming to my 8th question here, pretty much towards the end of the video, talks about that Hewlett-Packard accounts payable department receives an invoice from a vendor with the terms of 210 net 30. Now these are typical operational term, which basically means that the total credit period being 30 days, if you pay within the discount period of 10, you can get a discount of 2, which means the purchase is being done here. Let's say the entire amount of 100, let's assume the amount is 100, is to be paid at T30. But if let's say you are going to pay within this discount period, you might get a discount of 2 and you can end up paying 98 itself. Now this pretty commonsensical point that if the buyer has to pay within the discount period, he's going to pay obviously on the last day. And if he misses the discount period and come T11, then he's going to again wait till the last day of the credit period, because that's what time value of money fundamental is. If the total, the payment every day here is going to be made equal to 100, then there is no fun in making the payment of T12 here. Obviously commonsensically you got to make the payment of, T30 itself. Now, so that bottled down to the fact that 98 payment at T10 is coming out to be equal to 100 ka payment at T30. So which basically means you have to bear an interest for 20 days. Okay, now the question here is HP pays the invoice on its due date, okay, which is here. Banks are willing to offer a loan at 18%. Suggest which source of finance is preferable. Now at T10, I would have two choices. The first choice is to continue to take the loan from the supplier, and rather than paying at T10 in the amount of $98, I wait till T30. So I take the credit from the supplier itself, and supplier is charging $2 interest for 20 days. So I'm going to calculate the holding period cost first for these 20 days and then annualize the same. I'm using the same concept as holding period return being annualized on a compound basis to EAR. Effectively, the point is there you were receiving and here you are paying. So effectively, the formula that you would see for accounts payable, that complicated, difficult looking formula, is basically the formula of annualizing the holding period return. The other option that I have here is to take the loan from the bank at T10, a loan of 98 rupees, dollar or rupees, whichever is the currency, paid to this supplier and shift the liability towards the bank, in which case my cost is coming out to be 18%. So the two choices that I have is, number one, take the finance from bank, which is coming out to be 18%, and the one which is from the supplier is something that we got to calculate. So let's just try and understand how do we calculate the cost of credit from the supplier. So effectively, it is the interest upon the principal, which is going to be 2.04%, but this is for 20 days. I will have to annualize it pretty much using the same formula of holding period cost. I'm going to annualize it in this particular way. 1 plus holding period return raised to the power the total 365 divided by the holding period minus 1. So if I solve this, I am getting a number of 114456 minus 1, which is 44.56%. So the cost of credit from my supplier on an annual basis is coming out to be 44% compared to 18% from the bank. So my answer is pretty clear here. I'm going to take the loan from the bank of 18 at 8%, at T10, pay to the supplier and repay to the bank at T30. The question is, how much would be paid to the bank? The interest on 98 principal for 18% for 20 days turns out to be this much. So that's going to be the interest part, and along with the principal of 98, the total amount to be paid is equal to 0.967, which makes it up 98.967, which is lower than 100, which you would have paid to the supplier if you would have taken his loan. Okay, so this decoding part is pretty important from an exam standpoint. So now coming to my second last question, again from a very, very important concept of share repurchase, which is part of your dividend and share repurchase reading. It says that the share price of solar automotive industry is $50 a share. It has book value of 500 million and 50 million shares are outstanding. So one quick point that I can calculate here is that the book value per share is total book value divided by the number, which is coming out equal to be $10 a share. Okay, the total profit after tax is coming out to be 67.5. Now post repurchase of $10 million, so this is the total cash outflow for repurchase. Will the book value be more or less than the current value? So I got to first of all tell me that how much is the directional change in the book value here. Now if I recall the concept, if the book value per share before this buyback is lower than the market price per share, which means this particular scenario here, just clean this, which means this particular scenario here, then post buyback this book value is going to further fall down. So if I look at it, the book value is 10 whereas my market price is 50. Therefore I can say that my book value post repurchase will be lower than the existing book value. The question is, by how much? Will the book value be more or less? So the question is by how much? So let's calculate by how much, and the new book value is equal to, so I'm calculating book value per share. The new book value per share is old value divided by the number of shares that you have. So how many shares would you be able to buy? Using 10 million divided by one market price is 50. So the number of shares that I'll be able to buy using $10 million, if one share is $50 a share, it will be equal to 0.2. Therefore the total book value will be 490 divided by 49.8 as a new number of shares, and the answer for the new book value is coming out to be 9.84. So the new book value is 9.84, which you see is lower than the book value before the buyback. Okay, the second point here is, if the opportunity cost of fund is 7%, what is the post repurchase EPS? Now the EPS is basically the number of shares. So the new number of shares is what we know is 49.8. The new PAT will be the old PAT as reduced by any loss of earning because of this buyback. Now if you would see that the total cash outflow is 10 million and the opportunity cost is 7%, so it will be 0.7 million. Therefore my new earnings for equity is going to be 66.8 million and the new number of shares are going to be 49.8, giving me the new EPS of 1.341. Let us also look at the old EPS, which is the old PAT divided by old number of shares, which is giving me a number of 67.5 divided by 50, 1.35. Okay, so the opportunity cost of funds is 7% and therefore the answer is 1.341. If the repurchase is financed by the borrowed funds and the tax rate for that is 40%, will the EPS increase post repurchase? Now this is an important aspect here wherein we need to understand that when the buyback is financed by the borrowed funds, then you're effectively substituting one source of capital with the other. What I mean by that is you're effectively increasing the value of debt. If you need to look at that from an accounting standpoint, you're increasing the value of debt on your balance sheet while reducing your contributed capital. So in a way, you're not reducing your capital structure, you're just making a shift from one source to the other. Okay, in which case you got to compare the cost of two sources. Whichever is greater is going to decide, whether the decision was correct or not. So if let's say cost of debt is more than cost of equity, then it will turn out to be a bad decision. But if cost of equity was more than cost of debt, then it will turn out to be a good decision and EPS post repurchase is going to increase. So let us calculate the cost of debt post facto is 1 minus 40% is equal to 5.4%. Okay, and here the cost of equity was to be calculated using EPS upon MPS, which in this case the earning per share is coming out to be pre-facto 1.35, and the market price is coming out to be 52.7%. So you see that cost of equity is 2.7, whereas the new cost is exactly the double of it. So therefore EPS post the repurchase is going to fall down. Okay, let us also calculate that value of the EPS if it is funded by the borrowed capital. Again, the same calculation of EPS the way we did a little while ago, that your old PAT minus now the effective interest divided by the number of shares that you have, which is 49.8 million. So how much is the interest that you will have to pay now? Now interest will be 10 million, the total loan taken, multiplied by the effective cost of debt. So it is going to be 0.54. So it is coming out to be 66.96 divided by 49.8, giving me a number of 1.344, which is again lower than my original EPS. So that tells me that this decision is not a wise decision to take. Okay, so pretty interesting concept, in terms of the impact of buyback on the book value and the impact of buyback on the EPS. Very, very interesting concept. This brings me to the last question, which is again very, very critical, is the question on the breakpoints. Now you would recall that breakpoints is that amount of total capital at which the WACC changes. What I mean by that is, if you plot the WACC curve, which is marginal cost of capital schedule, you should get a straight line if there is no change in any of the cost. But if you look at this schedule here, if you borrow the debt from 0 to 100 million, then the cost of borrowing is coming out to be 8%. But if you raise the amount of debt, the same banker is going to give you a loan at a higher rate, so on and so forth. And the same is happening with the equity as well. So in a way, my WACC is going to change. WACC is equal to cost of debt, weight of debt, plus cost of equity, weight of equity. Now try and understand that these two, if remaining constant, which is 0.3 and 0.7, then your WACC is going to change only when there is change in cost of equity and cost of debt. So therefore my cost of equity is changing. Okay, so the first question that I have to answer is, how many breakpoints shall be there? Now the breakpoints at a total level will be the breakpoint because of debt and the breakpoint because of equity. So because of debt, my first breakpoint is going to happen at $100 million. My second breakpoint is going to happen at $150 million, because after that the cost is going to be constant. So there are two breakpoints that I'm going to experience because of this amount of debt. On the other hand, I'm going to experience one breakpoint only because of equity, because 0 to 125 it is flat 11%, and after 125 it is going to be flat 13. So there's only going to be one change between the two slabs. So in a way, I can say that there are two breakpoints because of debt and one breakpoint because of equity. So there are total 3 breakpoints that I will experience, which means that there are like 3 times a jerk will happen. Okay, now what are the values of those breakpoints? So because of the debt, I'm going to get the first breakpoint at this particular level. You would recall that the breakpoint used to come at the amount of capital of that particular source at which cost is changing, which is 100, divided by the weight of that particular source. So the first breakpoint is going to come when my total capital is going to reach 333 because of the debt. My second breakpoint is going to come like this, which is $500 million. Okay, when my total capital is going to be 500 million, then 30% of that is going to be 150, and that's where the cusp of this particular slab is going to change. On the other hand, for equity, there's only one breakpoint at 125, and that is going to come at, divide by 0.7, $178.5 million. So in a way, the first breakpoint is going to be experienced when my total capital reaches 178, and the second breakpoint is when the total capital will reach 333, and the third breakpoint is going to be when the total capital reaches 500. So these are the two, when the cost of debt will change, and this is the one where cost of equity will change. So with that, I am at the close of this particular the series, which is pretty interesting and useful to the student who is to cover up the entire corporate finance and just to look at some of the very, very important and critical concepts. Please ensure that you don't go into the exam without mastering these concepts. Should you have any problem, you should look at the YouTube channel finstudyclub.com and find some of the relevant videos there. So you can also note down the details of the way you can contact us. So with that, I am towards the end of this session. I hope the session was useful. I look forward to speak to you on my forthcoming sessions on FRA, ethics and equity, and I hope that in the meantime you also benefit from the sessions on fixed income derivative, quants and economics, which are being recorded by Amit. So here the idea of both of us, the instructors at Finstudyclub, is that you benefit towards the fag end of your preparation. The time is short, and always there is like the opportunity cost of time is ever increasing. So the idea is to bring you some of the last minute concepts which can really increase the chances of clearing the CFA exam. So with that, I wish you all the very best, and I hope that you benefit from all the sessions on all the 10 modules that we have we are bringing for you. So with that, thank you very much. Look forward to speak to you.